So we are doing this paper, October-November 2024, paper 42. That means it includes the management accounting section. And you have two questions to do in this paper. The first question was of standard costing, which is already done in the previous video. And now this is the second question, that is your source B, which is of investment appraisal. Okay. So when you go to investment appraisal, you are first going to see the question and you will scan what are the things that you are asked to calculate. So there is no theory in the first part. We are asked to calculate NPV. The second part says calculate IRR. And then there is accounting rate of return. And after that, there would be an advice. So there is no specific theory for investment appraisal in this paper. Okay, you have to read the question very carefully. Before going ahead, can you tell me what are the things that you need in the NPV method?
You need net cash flow.
You need net cash flow. That means you need your inflow, you need your outflow. Non-cash expenses are excluded. You need discount factor. We are given two discount factor, 12% and 18%. So which one are you going to take in NPV? In the net present value method, you are going to take the discount factor, which is the cost of capital. Remember, whenever we are given two discount factors, one discount factor is going to give us a positive NPV and another discount factor is going to give us a negative NPV. I hope you're with me. So I am reading the question. Not I, you are reading the question, Fatima, and we will try and spot out where we are going to put what things. Fine.
Okay.
Read the question, please.
The directors of S Limited are considering buying a new machine for $240,000 exclusively to make a new product.
They are considering to buy a new machine of 240,000. Can you tell me what is this? It is the initial cost. It will go out in year 0. It is not an inflow, it is an outflow. Okay, so you have year 0, and I could see below this that the life of my project is 4 years. That means that when I have to calculate NPV in my year 0, this is the net cash flow, outflow. I would have the discount factor column and the present value of it would be the same amount because the outflow is happening now. The present value of outflow is always multiplied by 1 because it's happening right now. Okay? Okay, go ahead.
Yeah.
Read.
The company intends to manufacture for 4 years. It is estimated, again, the directors of S Limited are considering buying a new machine for $240,000 exclusively to make a new product. The company intends to manufacture for only 4 years. It is estimated that the profit after depreciation will be $27,000 each year, and the sales revenue will be $400,000 each year.
Okay, so now this information is going to give us what? From this information, I derive that my asset is worth how much?
27.
The asset is worth 27,000. Wow.
No, the profit after depreciation is 27.
I asked the asset is worth how much? The asset is worth 240,000. I expected to use for how many years?
4 years.
I expected to use for 4 years. So my depreciation per year would be
60,000.
My depreciation per annum would be 60,000. So first information that I derive from all of this is that I have a depreciation per annum of 60,000.
Mm.
The second thing is I have sales revenue. My sales
400.
revenue is 400,000. Then I have some expenses and I am getting profit, which is before depreciation.
This is after depreciation.
I'm going to minus the depreciation of 60,000. I'm
Okay.
going to get profit after depreciation,
27.
27,000. That means my profit before depreciation is 80,000. Why am
80.
I doing this? Is 87,000, sorry. Because I had seen they have calculated, they've asked us to calculate ARR also. ARR requires the profit before depreciation. So this is some derivation that I have done and there is no residual value. Are you with me?
Yes, miss.
So now our first thing is I have to calculate NPV. Come on, tell me, how do I calculate NPV? I have my year 0. The project is going to last for 4 years. So I write year 0, year 1, year 2, year 3, year 4. Okay. My profit after depreciation is 27,000. Profit before depreciation is 87,000, which is exclusively from sales. And they have not told us anything about credit or cash sales. So my inflow every year is 87,000. My inflow every year is 87,000. Any doubt? Tell me if you have. Inflow every year is 87,000.
No, miss.
I have a discount factor of 12%. Inflow multiplied by the discount factor, inflow multiplied by the discount factor. This is the present value of the inflow received after 1 year.
Yeah.
This will be the present value of the inflow received after 2 years. This is the present value of the inflow received after 3 years. What is this?
The present value of the inflow
after 4 years. So present value of the outflow minus present value of future inflow. I have a positive NPV of 24,306. This amount minus all of this. Those who are watching the videos, it is advised that you pause the video, do your calculations and then restart. Okay? So we have arrived at our net present value, which is positive 24,306. I hope that's clear.
Yeah.
Now IRR. How do you calculate IRR?
The positive rate.
Give me the formula for IRR.
P plus
P plus
bracket N minus P, small bracket N minus P.
This is N minus P. Then
Multiplied by the small p over the P plus N.
okay, what does the capital P and the small p denote?
The NPV.
The positive NPV.
Yeah,
the
positive.
The capital N denotes
The rate.
Please
Negative
tell me
rate.
clearly. Capital will denote what?
The negative discount rate.
Rate or NPV?
Rate. Capital is the rate.
Capital is going to give me the rate. So this is the rate of positive NPV. This is the rate of negative NPV. This is the rate of positive NPV, and small p and small n, this is the positive NPV, and this is the negative NPV. I hope you're with me.
Yeah.
Okay. So the rate that is going to give me positive NPV is 12%.
Yeah, and negative is 18.
So it would be 18 minus 12. So this is 6%. Into what is my positive NPV value?
24,306.
Positive NPV value is 24,306. This one that we found out. 24,306. Now what do I have to do?
You have to find the NPV of the negative rate.
You have to find the NPV at negative rate. Okay. If I'm finding the NPV at negative rate, that means at what percent?
18.
At 18%, I am going to get this. The outflow would remain the same. Inflows would remain the same. I'm going to multiply it with the discount factors, which would be the new ones.
Okay.
Yeah, I'm going to get the negative NPV of 5970. So when I put all this, I am going to get an IRR which is equal to how much? 16.82%. When I put this on calculator, if you're just watching the video, I'll pause the video. Please put on calculator and check. Now we go to our third question that they have asked us. They've asked us to calculate ARR. How do we calculate ARR?
Average profit over average investment times
Which
100.
profit we are going to take? Profit before depreciation or after depreciation?
After
We are going to
depreciation.
take profit after depreciation. Have they already given us the profit after depreciation?
Yeah,
Okay.
27.
So 27,000 is the profit after depreciation. How about the investment, average investment?
So
It is your
cost.
2,40,000 divided by
Yeah.
2.
120,000.
No, average profit, average investment.
So total profit divided by
Investment, average profit per year. Okay. So average profit is 27,000. Average investment is 120,000 into 100. Your ARR is how much? 22.5%. Yeah?
Yeah.
Okay, fine. We go on the deep part. Now the deep part is telling us something. Additional information. The directors adopt the NPV method for this investment appraisal. That means they're going to appraise the project, or they're going to find out whether they have to invest in this project or not by using which method? By using the NPV method. And they're about to make a decision to buy the machine. But the sales manager, he thinks that the estimated sales revenue would only be 380,000. All other information remains the same. All other information was this information that we had.
Yeah.
Okay. Now the previous information that we had was that the sales revenue is 400,000. Yeah. But the additional information says that the manager thinks that the sales revenue will be 380,000. And they want to do an investment appraisal based on the NPV. So before, we thought that our cash inflow would be 87,000. But now the sales manager is saying that the sales is going to be 20,000 less. So our new cash inflow would be 20,000 less. Please think over it. Mahat.
But the sales doesn't mean it's profit, right?
We had this format that I told you. I had given you over here. Sales minus expenses. Sales minus expenses. You got the profit before depreciation. That was the inflow. Now the manager is saying that the sales will not be 400,000. It is going to be 380,000. Other information remains the same. Since this is reducing by 20,000, our profit, the cash profit would also reduce by 20,000.
Okay.
Yeah. So our new cash inflow would become 67,000 now. I hope you're with me. Every information remains the same. I want to decide whether I have to buy the machine or no using the NPV method. So I have the outflow, cost of capital is 12%, and my new inflow would be 67,000. This is the only thing that is changing. So now I have a negative NPV. NPV is what? Negative. Should I invest in the project or no? Fatima?
So the MPV is negative,
Okay.
right? So then you should
I
not
should be
accept the
concerned
project.
about the uncertainty. The decision
Yeah.
is going to change. Okay, it's 6 marks, so you're going to get 3 to 4 marks for the calculation. The NPV is negative, so the directors should think about it. They should be certain if the sales is going to be 380,000 or no, because that's going to make a major impact on their decision making. If they are certain about 380,000, seeing the negative NPV, they should reject the project. If NPV is negative, the project should be rejected. Okay. Let's go to the E part. No, it's a C part now.
Yeah.
Theory. Please read the question, Fatima.
The directors are preparing the cash budget for year 4, and they have 2 options available for amount of $80,000. Option
Okay.
1, continue the manufacturing of product A for 2 more years by launching a promotional campaign. Despite the machine being fully depreciated, it can continue to be used for 2 more years. And option 2 is design a new product B, to be launched in year 5.
What is the question actually trying to tell us?
So advise the directors which option they should choose.
They are preparing cash budget for year 4. What does this mean?
This means that
They have 2 options available for an amount of 80,000. What is this 80,000 amount that they're telling?
it's the cost, right?
First, our NPV was 80. First, our inflow was 87,000, right?
Yeah,
Then the inflow became how much?
67.
67,000. Every year it has reduced by how much? 20,000. So this has reduced by in all 80,000. Every year the inflow is reduced by 20,000 and they are in a shortfall of 80,000. Fatima, please reply.
Yeah, I'm confused about this part.
Okay. First, they were going to make a sales of how much per annum?
87,000.
Sales per annum, 400,000.
Oh, okay.
Yeah.
Yeah.
First, they're going to make a sales of how much per annum?
400,000.
Now they're going to make a sales of how much per annum?
380,000. So there's a reduction of
Per annum
20,000.
shortfall is 20,000.
Yeah.
The project is
So
going to remain for 4 years.
okay.
So there's an 80,000 shortfall.
Okay. Yeah.
So for this amount of 80,000, the directors are thinking about two options.
Hmm.
They're thinking to continue to manufacture the product A for 2 more years.
Hmm.
So even if the machine is fully depreciated, it can be still used for 2 more years so that they can manage this 80,000 deficit that
Yeah.
they're getting, leading to a negative NPV.
Yeah.
Or
Yeah.
they are thinking that they should launch a new product in the year 5 using the same machinery,
Hmm.
cover this negative NPV and make it a positive NPV. Advise the directors which option they should choose.
So it's just advantages and disadvantages
So
of
if
the options, right?
you the same product in year 5 and year 6, if they're choosing the option of producing in year 5 and year 6, they are going to make 380,000 more of sales revenue.
Yeah.
Minus the expenses and profit before depreciation would be 67,000. Yeah?
Yeah.
Profit
Yes, miss.
before depreciation would be 67,000 in year 5 and another 67,000 in year 6. So if they choose option 1, they will not have to spend to design a new product. They are not buying the new machinery. They don't have to train their workers.
Yeah.
Profit will increase.
Yeah.
Okay. The profit after depreciation would increase. Annual profit will increase.
Hmm.
And it is uncertain that the sales level can be maintained, but mostly the customers would be there, so they don't have to spend too much on the advertisement.
Oh yeah. Okay.
If they choose option 2, and even they will get a positive NPV then.
Hmm.
If they choose option 2, see why are they telling they are not sure about the sales is because every product passes through a life cycle, which is called the product life cycle. Growth,
Yeah.
introduction, maturity, and then it starts
Decl-
falling. Then a new
yeah.
product enters into the market, it will again follow a life cycle. So that is why
So
they are
that's
not sure about the sales remaining the same or no. But if the sales remain the same, the option 1 is a very good option.
hmm.
Option 2, using
Option
the
2.
machinery,
New.
they want to design a new product.
Hmm.
So new product can appeal the existing customers. Okay,
Yeah. And bring.
diversification would be there, but it may
Yeah.
require a new machinery which is not permissible given the flow.
Hmm.
Workers need more training, and we are
And
not
success.
very sure about the commercial level of success. See, it's for 7 marks.
Hmm.
So you have to give 3 points for option 1, 3 points for option 2, and then the advice.
Okay.
So I suggest that they should extend the production for 2 more years as it has
Hmm.
more benefits and less uncertainties. That's my suggestion. You can use your suggestion. So with this, we complete the October-November 24 paper 42 source B question number 2.